So today I wanted to talk about autocorrelation. So this is a more advanced statistical concept, but has applications in strategy development. And I wanted to discuss it in a more introductory way for this piece. And some of the subsequent pieces that we're going to do, we're going to talk in more granularity how you test for autocorrelation, how you use autocorrelation to develop autoregressive models, which have a ton of applications, especially for options traders and volatility traders. But today we're just going to introduce what autocorrelation is and sort of why it matters. So to start, we have previously discussed correlation and why it is important for trading. And usually when we talk about correlation as it's on its own, we talk about it with respect to risk management. So we really want to use correlation, or we often use correlation as a measure for diversification, because it gives us an idea of how similarly two underlyings might move together. So it gives you a little bit of an idea of the directional concentration that certain components might be contributing to a portfolio. But today I wanted to talk about autocorrelation, which is a more advanced statistical concept, but it's still very important for understanding especially outlier risks and creating more realistic models of volatility. Does that make sense?
Yes.
Hell yeah. Okay, so just to recap correlation, we've talked about correlation before. It's again very common concept for people who develop statistical trading strategies and look at diversification from a slightly more advanced lens. But just to recap, so correlation is a very useful tool for measuring the historical relationship between the returns of two assets. Specifically, we're looking at returns. So more specifically, correlation measures the extent to which two variables are linearly related. There we go. And to get a visual of what exactly that means, here on the right, we have a plot of SPY returns versus QQQ returns. So these are the returns over some time frame for these two underlyings. And what you can see is that there's a very clear linear relationship between the returns of those two assets. So what this means is it's a positive linear relationship. What this means is when SPY tends to have a large up day, the NASDAQ also tends to have a large up day. And when SPY has a large down day, the NASDAQ also tends to have a large down day. They tend to move in tandem, which we can measure with correlation. And specifically, when we use correlation, we are assuming that the underlying relationship is linear, which is what this kind of looks like here. Does that make sense?
Yeah.
Easy. So the Pearson correlation coefficient, the way that it's calculated, you don't need to know this to know how to use this, but I decided to just throw it in here for people who are interested in exactly how this is calculated. But when we use the Pearson correlation coefficient, there's a bunch of different ways that you can measure correlation. This is one of them. But this one is specifically the covariance between two variables divided by the standard deviation for each. And what this is really used for is to measure the strength and the direction of that linear relationship that we talked about before. So the stronger the relationship, the more towards 1 or -1 that value is going to be. And then the direction of the linear relationship is going to be dependent on the sign, and we'll look at examples for that in a second. But the way this is actually calculated is just the covariance between the two variables. So think of this as the kind of the joint variability between the returns of two assets. And then we're just going to divide it by the standard deviation for each asset. So we're looking at specifically the root variance for asset 1, the returns of those assets, and then asset 2. So that's really all the calculation is. Again, you don't really need to understand the subtleties of this equation to be able to know how to use it, but I wanted to include it just so that it's there. But how you actually read the output of this calculation is right here. So again, we're trying to measure the strength of the linear relationship, and the value of that output really ranges from -1 to +1. If we have a +1, that indicates a strong linear relationship. So when one goes up a lot, the other tends to go up a lot, and vice versa for down. So this example would be SPY in the NASDAQ, which shows that strong, again, positive linear relationship, which we can measure with the Spearman correlation coefficient. Make sense?
Yeah.
So in this case, we have that strong linear relationship. It's positive. So we get a Spearman correlation coefficient of 0.9. On the other hand, if we look at SPY returns and gold returns, we can see kind of more of a blob. There's not really a clear linear relationship between these two underlyings, which means that our Spearman correlation coefficient is fairly close to 0. So when we get 0, that means we do not observe a linear relationship in the data. But there might be other relationships, but there's no linear relationship that we can observe. And then on the flip side, the -1 indicates a strong inverse linear relationship. So this example might be SPY and TLT. So we can see a negative line. It's not as strong as the linear relationship we're seeing between SPY and the NASDAQ, but it still shows inverse correlation. So when one goes up a lot, the other tends to go down a lot, right? And they tend to move opposite kind of one another. But we can see, again, so the Spearman correlation coefficient is 0.48. So it's not as strong as it could be, but we still can observe the relationship nonetheless. And that's really all it takes to use correlation. Does that kind of make sense, or to interpret correlation? So that's all recap, talking about correlation, what it means, why we might want to use it. But now we talk about autocorrelation, which is a little bit different. So the correlation between two assets, it gives us as traders an estimate for how similarly the returns of two underlyings tend to move historically. It's important to remember it's a historical metric. There are limitations that come with that, but that's what we tend to use it for. Autocorrelation, on the other hand, describes how similarly an underlying moves compared to lagged versions of itself. And I'm going to talk about an example of what that means in a second. But autocorrelation, instead of looking at how similarly two underlyings tend to move together, for autocorrelation, we want to look at how much the current prices of the underlying are related to the past values of the underlying. So we're looking at different lagged versions of the time series of the returns data itself compared to the current version of the series, which is not lagged. Does that kind of make sense?
Yeah.
So we're looking at the returns for one underlying relative to itself, rather than looking at the relationship between two underlyings. I'm going to show the math, but then talk about an example of exactly what that looks like in a second. But that's really the definition of autocorrelation. So when we look at the formula, and this is, again, something you don't need to know how to create, or you don't need to know how to calculate, but it's in order to use it, if that makes sense. But I wanted to include it here for completeness. But the formula for the autocorrelation function, which is represented as ACFK, this is the autocorrelation function with lag k. And what that is simply the covariance between the series and a lagged version of itself divided by the variance of the series. And the lag is something that we're going to define. Usually we use a series of lags. So different lagged versions of the series, which I'll show in a second. But it's very similar to when we look at the correlation between two underlyings. Here we're just replacing one underlying with a delayed version of the time series itself. Does that make sense?
Yep.
Cool. So it's the same kind of correlation. We're just replacing what series we're using as a reference for the current series. But what that actually looks like in the data is right here. So for example, let's say that we have 7 days worth of data and we have returns 1.34%, 0.22%, and so on. When we looked at a lagged version of the series, we're just simply shifting the series in time. So when we look at the lag 1 series, we're taking that 1.34, 0.22, 0.07, whatever. We're shifting it by 1 day. That gives us a lag of 1. The lag of 2 is then shifting it by 2 days. And so for the returns and then the lag 1, we're going to look at the correlation between the underlying return series and then a lagged version of itself. We're going to look at that same correlation between the returns and then a lag 2 series of that underlying. And we're going to say, like, okay, so when we look at the lag version of the series and the current version of the series, how similar are those two series? It basically tells us how much current values of, current returns values not depend, but are maybe similar to previous values of the series. Does that make sense?
Yeah.
Okay, so that's kind of what an example of the data might look like. So here looking at 2 different lags, so lag 1 and lag 2, and how we interpret this when we take those 2, series and then put them in the autocorrelation function is we're going to get a value that's very similar to what we looked at before when we look at the correlation between 2 underlines, but the interpretation is going to be a little bit different. So when we look at the output of the autocorrelation function, it's also going to look at the strength and direction of that relationship, but the implications are going to be a little bit different. So if we have a correlation value of 1, that basically means we got perfect correlation. So that means that if we look at the current returns value and we look at a lag version of the returns value, we're going to see something that's identical. And the significance of that means that there's some degree of price trending, right? So when we have one big upward value today, there's maybe a higher chance that we're going to have another big upward movement tomorrow or another big movement tomorrow, right? So we're seeing trending in the price. And I put an asterisk next to that because I don't want this to be conflated with using past performance to indicate future returns, if that makes sense. That just means that over the time that you are looking, over the historical time frame that you're looking, there was some degree of price trending where previous values tend to have some indication about what future values would look like, or rather that current values were somehow related to past values in the series of returns. Does that kind of make sense?
Yes.
So then when we look at -1, we see kind of the opposite of that, where it's perfect inverse correlation. So the series and a lagged version of the series have opposite movements together, if that kind of makes sense. So that is more, more consistent with price reversion or oscillation, where, if we have a big movement yesterday, then we might have a big movement to the opposite side tomorrow or something like that. So, for example, when we see price reversion or oscillation, that's a little bit more consistent with negative autocorrelation. And then when we have an autocorrelation of 0, that basically means that the lagged version of the series is uncorrelated or doesn't really have any strong relationship with, the current version of the series. So it's very similar to how we interpret the correlation between two different prices, but rather we're trying to look at if current prices are at all reflected in past prices, which is something that we do happen to observe in actual markets, right? We talk about this all the time. When you have a big day today, there's a pretty high chance that you're going to have a big day tomorrow. We see this with sell-offs. When we have a really big move to the downside today, there's maybe a higher chance that we're going to have a really big move to the downside tomorrow, for example. But again, we want to put an asterisk next to this because we don't really want to rely heavily on this for strategy development. I think at least that's how we tend to think about it over here. Does that make sense?
Yeah.
So, right. So that's hopefully a little bit of an introduction to what autocorrelation is and how we interpret the data. Why does this matter? So from a statistical perspective, autocorrelation matters because it means that there's a lack of dependence lack of independence rather, between the variables in our series. So what this means is that if we have current values that are not independent from previous values, that can kind of screw up financial models because many financial models, many statistical tests rely on independent values. So the value of the market today has absolutely no relationship whatsoever on the value of the market yesterday. That is an assumption that a lot of financial models and statistical tests rely on. So when we observe autocorrelation, that can screw stuff up a little bit. And then the other reason is that systems with significant autocorrelation also tend to have much more extreme values, or fat tails, than systems that exhibit none. So in order then to understand outlier risk on a more subtle level, on a more advanced level, it also requires you to understand autocorrelation, which is very fundamentally different from more basic models of price movements like what we see in the Black-Scholes. And then finally, from a slightly more, in addition to technical analysis strategies, there we go, which I personally don't use, but in addition to TA strategies, also autocorrelation can also be used to form autoregressive models, which can then be used for more advanced strategy development, such as volatility forecasting, which I'm going to talk about more next week. So hopefully that shows a little bit about why autocorrelation matters. Hopefully you guys understand a little bit better what it is. We're going to get into more detail, I think, in the next couple of pieces. But what do we think?
No, this is definitely great. To be honest, I haven't seen autocorrelation before.
So personally, when I use autocorrelation, I use it. I don't really use it in the context of TA, really. I don't use it to try to predict price movements. I've used it before for volatility models. And for volatility models, we can, there's, I think, examples of like why this might be useful from less of a TA perspective. Because if we treat market movements as completely independent, right, then if we have a 2% drop tomorrow, then we shouldn't really expect anything in the following days. Like there's a range of possible values that could happen after a 2% drop, and any one of them are equally likely, or as likely as they are based on whatever probability model you're using. But we know that that's kind of not what we see in actual markets. If we have a 2% drop tomorrow, like a lot of the times that's predictive of more volatility to come, because a lot of the time that's what we see. When we see a big 2% drop, we might see a drop day the following day, or an even bigger drop the following day. So we can see that volatility tends to cluster together. Volatility clustering is what we call it. And autocorrelation is one way that we can kind of understand that market phenomenon on a more statistical level, if that makes sense. So when we are trying to create more accurate models of volatility, then this sort of like avalanching effect, the sort of escalating effect might be something, or is something that's pretty important to be able to understand that as completely as possible. But personally, I would use it more for like volatility forecasting, which I want to talk about next week.